Yo guys, Clem here. We are back with another video. But before we get into that, I just wanted to let you guys know I've started a little Twitter where I'm going to be posting some daily updates on GBP USD and Euro USD. I might drop a couple of trades in there as well, live trade updates. So give that a follow, and then tweet me with a picture of your trading setup, so I can see, what sort of setups you guys are trading on. And once we hit 1,000 subscribers on the YouTube and 1,000 followers on the Twitter, I will drop a Telegram channel where I will drop, a couple of signals a week and, some daily chart updates and outlooks for, some of the markets. Now, let's get into the video. So in this video, I simply wanted to go over refining your stop losses, how to get your stops from something like a 1 to 1.5 or a 1 to 2 to more like, more better, 1 to 6s, 1 to 10, stuff like that. It's a very simple process. It just involves having a kind of deeper understanding of the market. Anyway, I'll quickly just run through a trade that I took yesterday on GBP USD, which was this short here. Now, as you can see, right, my structural range I had was from this high. It's an awful line. That's an awful line again. It's from this high to this low, right, which we obviously broke structure here. So my trading range was from here to here. Then what I did very simply was I pulled my GAN box out and I drew on my premium discount, you could say, and I selected this point of interest, this wick on the 15-minute chart. Now, if I go down to the 1-minute time frame, you can see exactly why I selected this point of interest and nothing above or below. Basically, you can see that it's a large wick on the 1-minute time frame. It's a lovely sort of institutionally funded candle that you can see, and we have this large impulse away with these relative equal highs dropped here, as a bit of inducement. Now, I also was potentially interested in this level. However, price didn't come to that, which is absolutely fine. I was more expecting price to react out of this level. And the reason I selected the 2 candles is because this bearish engulfing engulfs this whole range. So really this whole range is the POI. However, I just selected the unmitigated section of that, which was here, which also happened to coincide with the top third of the range here, which is obviously my very high probability area where my A+ setups do come from. So back to the 15-minute time frame. This trade came at about 6 a.m. UK time. It's a little bit early. However, I've seen this play out time and time again in Asia. Right, we built these relative equal highs. We failed to hit the top third of the range. We just missed that. So then price came in at obviously 6:15 UK time, and I hit short somewhere about here, and I just covered this point of interest with about an 8 pip stop. I actually think I had about a 6 pip stop, so I must have got in somewhere up there. And on my funded accounts, I just targeted this low for a nice 1 to 7, 1 to 8, and on my personal account I held it a little bit longer and got out at a 1 to 11. So very, very simple. Going into 2023, I really refined down my trading plan and made it super, super simple. So if you do want, some information on that, obviously get me to 1,000 subscribers on the YouTube and I'll drop my Telegram channel. Anyway, in terms of refining your stop losses, the easiest way to do it is obviously you want to be trading pro trend, right? So let's say this is our trend. Obviously we are bullish. And price starts to pull back. We want to draw our range on there, and the only levels we should be interested in are down here in that lower 30%. And obviously if we're selling, then it's the higher 30% if it's a downtrend. And usually what you'll find is in this area there's only maximum 2 valid points of interest that you can buy or sell from. So what you can basically do is, I'll give you an example here. You can just hit sell, right? So here, on the 1 minute time frame, I said that I also had a level up here that I was interested in, right? So if I just draw that on for an example, so let's say here, right, we had 2 levels, and they're both in the top 30%. Well, initially, right, you could theoretically do something like this, have a 22 pip stop loss and just target the low, and then you have a nice 1 to 2. However, we want to be a little bit more smart than that. At the end of the day, trading is a maths problem. So if you can find a way to skew the maths of your trading in your favor, then you have a higher probability of winning. So obviously this is a 2R, right? So let's say, let's just put a note on the chart saying that we took that trade and we are +2. So now let's say that you were smart about it and you realized, okay, I've only got 2 levels here, so I'm prepared to take a maximum of 2 hits. So what I'm going to do is, when I see a decent rejection from this area, I'm going to hit sell, and I'm just going to cover this candle's high. Now that's a 5.8 pip stop, 6 pip stop. You could even go down to 5 pip stop or smaller, and just target the low, and there you've got a 1 to 10. So let's just say, okay, you take a loss there. So now instead of being +2, you are -1, right? That's absolutely fine, not to worry. And let's imagine that price came into this level instead. It took you out here, you took a loss here, and price comes into this level and reacts again. So you can just do the same thing, right? When you see a decent reaction, you just cover the candle high and then target obviously the low. And now this is a 1 to 13 / 1 to 14. So now you are net positive, let's say 13R, right? Opposed to being net positive 2R. So can you see the benefit in doing something like this? Yes, over 100 trades, you will definitely take more losses than just, doing your standard 1 to 2s like this. However, also over those net 100 trades, you're going to have many trades with R's like this, right? And so long as you keep all of your losses being just -1, or some trades you might have, they'll be +5, others will be, +7, some you might have that are +10, and eventually, a couple of times a year you might have some that are +20s. So over the course of, let's say, 150 trades, what do you think is going to be more profitable? You taking +2s, or you taking, say, a 50 or 60% win rate with a couple of -1s, but all of your winners are above 5R? Do you see what I mean? So just some food for thought there. This is literally only using the 15-minute time frame as well, so it's super simple. There's obviously ways you can utilize the lower time frames so that you can get those super tight 2-3 pip stop losses. However, this year I'm moving away from that as I'm more focused on my strike rate, and 1 to 8s and above isn't really too bad. I hope that this video makes sense and that you understand it. Of course, if you don't, leave a comment and let me know in the comments, and I will also link my Twitter in the comments too. Drop me a follow and send me a picture of your chart setups, and I will see you in the next video. See you later, guys.